basically, waiting to roll. You just saw we were looking at Altera, and we used that profit and loss chart there, and the profit and loss portfolio, I'm sorry, to evaluate where the position stood. We looked at the position analysis to see where our position stands right now, and then we compared that to some of the rollout opportunities that were listed. Well, just because a rollout opportunity is listed in the portfolio, does that necessarily mean that you have to make the adjustment? Absolutely not. In any strategy, whether you're using the married put techniques discussed in the blueprint, or you're using standard collars, or if you're doing covered calls or naked puts, sometimes you might want to wait to roll a position. Now, patience, of course, is a virtue for any trader, and it can lead to higher profits if your expectation is the stock's going to continue to move in your direction, whether that's up or if you're in a bear strategy if it's down. But you also don't want to miss an opportunity. The tool that we just showed will really help you evaluate where does my position stand right now. If I leave it alone, what's going to happen if the stock continues to X price or Y price, or what's going to happen if I entered this adjustment, okay? Now, at times, it might be best not to simply roll a position because the opportunity is there. You may want to wait for other opportunities before selecting a new strike or applying a new adjustment. We want to take a look at two covered call examples today, but the theory behind what I'm showing is also going to apply to the married put techniques, that sometimes just because a rollout opportunity is listed doesn't mean you have to take it, doesn't mean you have to force a trade if it doesn't match your expectations. But let's talk about two covered call positions. There's one on Exxon Mobil. I talked with a customer earlier this week regarding this position. The customer has a position, a covered call, that is now in the money heading into December expiration. The investor wants to hold the stock to avoid assignment. So, of course, he has really only a couple choices to make. Either choice he makes, he's going to have to buy to close his call that's now in the money, but what is he going to look to do after he closes the call? And then there's an opposite scenario on REE, rare earth elements, that is now out of the money heading into December expiration. Customer entered into the covered call. The stock dropped shortly after that. Customer is actually holding a January strike call option. Now, the goal here is to roll down the position to help hedge the loss on the stock itself. And of course, I have hedge in parentheses there because there's only one way to truly hedge a long stock position. And of course, we'll discuss that. But let's look basically at the first covered call position. On on December 1st, customer opened an XOM position, bought about 100 shares of stock at 70, and sold the December 70 call for $1.18. Now, the situation today on 12/15 is that Exxon Mobil is trading above $72 per share. The call that he sold is in the money, and he wants to continue to hold the stock and maybe earn extra income. Now, with the stock position being in the money and being this close to expiration, it's near the maximum profit, of course, he expected when he first opened the covered call. And what I mean by that is that there's really little time value left in the call option, so he's near the maximum profit if he's assigned at expiration. Those of you who are experienced with covered calls trading would think the common rollout, I'm going to buy to close the December 70 call, stock above 72, and I'm going to sell to open the January 72.5 call. Well, okay, that's a reasonable rollout opportunity, but what about other positions? What other strike prices might be available? Well, let's take a look again back at the portfolio tool on power options to see where that position stands. Now, here's the covered call view, and we have our Exxon Mobil position, stock price of 70, that was the entry price, and we sold the 70 call for $1.18. The stock is now trading above, right at 72, 72.01. And we're shown, of course, a price of $2.09. The buyback cost for the position is $2.09. Now, over on the right, we can compare where the position stands right now. My original expected gain, or the original expected gain on this customer's position was 1.7%. Smaller premium, the customer, this is actually a position a customer has been in for a long time, has been continued to roll. We're just using the example of buying the stock at 70. Because we're near to expiration and the position is in the money, of course, if the position was liquidated right now, sold to close the stock, and bought to close the call, the customer would realize a return of 1.6%. Again, very near to the maximum expected profit. And if the position is held all the way to expiration, and I mean by all the way I mean the next 3 days, the customer will realize a 1.7% return. But remember the goal and the expectation. The goal for this customer is that he wants to hold the position. So naturally, he's going to have to buy to close this call, and the common view of covered calls trading is we just roll to the next highest strike price 1 month out. Well, let's take a look at the evaluation. Again, we'll go to Position Actions, and let's select Position Analysis. And as we discussed just before with that married put we saw in Altera, we have a breakdown of our original position. Exxon Mobil's trading at 70. Sold the December call for 118. As we scroll down, we have the graphical view of our profit and loss chart, where our position stands right now. And we see again that liquidation, original position value, I apologize, our current liquidation value. We've made roughly 93.2% of what we expected to make on this position. And of course, if we hold it all the way to December expiration, 3 days from now, the maximum gain of 1.7%. But then we're shown some potential rollout opportunities. Well good, this actually added a different one for us. Earlier today it was just the 72.5 call that was shown. But now we're shown we can roll to the January 70 call for a new potential percent of assign of 2.7%. So we'll gain 1% of potential profit instead of letting ourselves get assigned by rolling to the rolling to the 70 call for maximum 2.7% of assign for the next 38 days. And we have a 72.9% chance of the stock staying above 70. Or if we want to earn extra profits, we could roll to the January 72.5 call. We'll collect $1.22, which would make our adjusted net credit 26 cents. That includes the original premium we received minus the buyback cost. So our potential percent return if assigned at January expiration will be 4%, or 44.9%. So we gain an extra 2.3% roughly by rolling to the January 72.5 call. And of course, as I mentioned, we can compare them side by side by using that More Information button and going to Simulate Trade. But what about other opportunities? Why are there no February opportunities shown, and are there any other further months out? Well, in this scenario, the next expiration series, we do have the January series available, so we can evaluate these. But if we link to the option chain to see what else is available, what other opportunities might be available to roll, we see that we have our December series. It's coming up to expiration. And scroll further down, and we see the January 72.5 call that we linked to. But for this particular option series, there are no February or March options available. The next available series is April. Well, that might be a small problem if you're not comfortable with the return that's available for the January rollout opportunities, or you maybe think the stock's going to grow further. You might not want to just simply roll to the next strike price. You have a couple of options. Number one, you could simply buy to close the call now and then wait for the stock to move further, look to sell a call at a higher strike price if the stock continues to move up. Or number two, you might want to buy the call back now and then wait till Monday or Tuesday of next week. As we're approaching December expiration, we don't have a February series available. But Monday and Tuesday of next week, that new series will be released, so we'll be able to evaluate potential rollout opportunities going to January, selling a new call for January expiration, that 72 and 70 call that appeared here, but compare that also against the new February series, the 70 strike or the 72.5 strike as well. So although the tools will greatly help you identify what positions and the new calculations for the new percentage return if assigned, the new downside protection, what matches your risk-reward tolerance. But remember, patience is a virtue. This also applies to the married put techniques. Just because an income method is shown doesn't mean you have to apply it. Well, the adjustment thoughts in the XOM, well, we need to close that call to avoid assignment. We could, of course, roll to that 72.5 call if it matches our personal goals. However, if I'm right now expecting that XOM might be trading at $74 or $75 in the next 30 or 60 days, I might not want to sell the 72.5 January call right now simply because I'd be faced with the same discussion 30 days from now. In January expiration, I'm looking at, well, what do I roll to now that I let the position get in the money again? Other opportunities weren't shown because the Aprils were too far out in time, and there's no February series available yet. It's going to be available in a few days. So it's not necessary to simply roll to whatever opportunity is shown. You want to close, in this case, the December call or the call that's in the money to avoid assignment, if that's your goal and expectation, and then wait till Monday or Tuesday of next week to evaluate the roll or continue to hold it if you expect the stock to continue to move up. And then you might be able to wait to sell the 72.5 call for a better premium or the 75 call in the January or February series after the stock moves up in price. Now, just take a look at the REE example as well. This is reverse of what we just looked at with XOM. For the REE example, 100 shares of rare earth elements were purchased at 11.30. And at the time, the January 12.5 call was sold for 75 cents. This was a much more volatile position, so there's much more inflated premium. Now, rare earth elements dropped shortly after that. It's currently trading at about $9.50. So it's our different scenario. It's declined, and you may look to try to hedge some of the loss you've taken on the stock by rolling the 12.5 call for January down to, that's another important point, I'm sorry, this is the January call. It was sold further out in time in mid-December. Okay, so we may want to buy to close to 12.5 and maybe sell to open at 11, or a 10-strike call to reduce some of the loss we're taking on the stock. Well, we could buy to close the January call now, but roll to April. Well, again, that's another 122 days out in time. It's the next series that's available out to January, after January expiration. We have to evaluate, does this match our personal goals or our time frame? And let's go back now to the portfolio tools and take a look at where REE is right now. In the profit and loss chart, we have the stock at 11.30. We sold that 12.5 call for 75 cents. The stock's moved up a little bit since we started this presentation. It's now at 9.88. The buyback cost for our short call is 20 cents. Now, over on the right, we look at the position as a whole. Our total expected gain or loss was 18.5%. That was if and only if the stock was trading above 12.5 at January expiration. If the position was liquidated right now, there'd be a loss of 8.2%. And if the position is held all the way to January expiration, the stock's still trading around the same price, there'd be a loss of 6.4%. But again, what adjustments are available right now? I don't want to do this all in my head. I don't want to do it with pencil and paper. So let me use the Power Options tools to see what adjustments are available for the REE, rare earth elements, covered call position that has declined in price. Again, in the simulate trade or the position analysis, we start off with our original stock and call entry price, where the position stands right now. This is in real time, so we see that the stock has jumped up again, is now trading at 10.01. Just from when we linked over, it went from 9.88 up to 10.01. The default break even is 10.55. The 11.30, of course, minus the 75 cents. And it shows you our time value left in our call price, current call delta, and the days remaining to expiration. As we scroll down, you have that original position value, current liquidation value, again a loss of 7.5%. That changed in real time because the stock had moved up to $10 now. We were looking on the profit and loss portfolio, it's only at 9.88. And our expected return, future expiration return, if we hold the position and do nothing, the stock's trading at the same price, would be 5%. Well, we look at our available rollout opportunities, and we see that we could roll down to the April 11 call, or roll to the April 12.5 call, or even the April 11 call, but this is 122 days out in time. It's a long time frame to roll a covered call. Now we see here that the math is done for us again. If I rolled to the April 11 call, and we were signed at April expiration, we'd have about a 12.2% return, and there's a 41.8% theoretical chance that the stock would remain above 11. Now, why am I not seeing any January positions, or why am I not seeing any February positions? And again, rather than analyze these positions, let's go to the option chain and evaluate where we stand. Well, there's our December series. We have January options, but we're holding the 12.5 call. We're not going to be able to get a lot of premium by going to the 11 strike or the 10 strike to turn this loss into a potential gain, so it wasn't shown And then again, we don't have any February options, so what we're looking at here is the next available series is April. Well, we do have a January series. We have a January covered call right now, so this is another scenario. Let's see here. Let's go back. Another scenario where we might want to wait to roll the call until the new series is available. After Friday, the February series will appear. So we want to roll the call to hedge loss in the position. Remember, the only true hedge for a long stock position is using a put option as a collar or a married put strategy. It's the only one that gives you a limited risk or a limited loss that's guaranteed. Now, when you were evaluating that rollout, if those April positions, that April 11 call that showed a new 12.4% return if assigned for the next 122 days, if that matched your personal goals and expectations for the position, that might be a position you want to use. Well, the cons there of rolling to the April calls that you might be locked in that position for another 122 days, depending on what the stock does, the fluctuations in price or how things change. So you might not be able to make any adjustments and stuck in the position. Of course, this is another view where you just might want to exercise patience. You might want to hold the current position and evaluate the rollout on Monday or Tuesday. We don't have to close the January call right now because we're not risking assignment, and we're 1 month further out than the upcoming expiration, but we are losing on the stock and our call has dropped significantly in price. Now, the cons with holding the position, of course, is that the stock can continue to fall over this weekend before Monday and Tuesday of next week when the new February series is available, resulting in further losses. And you could also use the profit and loss chart, as we did before when we were evaluating that first married put, to see if there were collar or married put opportunities that could help us limit our risk but still have a potential gain. And our other choice, of course, is to take the loss, liquidate right now, and then evaluate what went wrong. But just because a rollout opportunity is shown in the profit and loss portfolios doesn't mean you don't feel forced to go and make the trade right now. Evaluate it using that simulate trade feature to see the two comparisons side by side and see, does this match my personal risk reward tolerance? Does this match my goals and my expectations of what's coming up next? I wanted to just do this brief presentation for today as we are approaching December expiration, and these two positions we discussed were actually two positions I had with Power Options customers during coaching sessions for this week. One customer, of course, is in that XOM position, wants to roll the call but didn't like the January series, so he might want to wait, just buy to close the call to avoid assignment, and then Monday or Tuesday see what the February covered call opportunities would look like on his position as well as the January. And in the case with REE, you could roll to the January positions, but it couldn't be rolled for a credit. It would actually cause a further loss on the position because of the premiums. And of course, the April positions were just too far out in time. So the idea is maybe just hold the position over the weekend, might get a little bit more decay out of that January call, and then Monday or Tuesday of next week, look at the rollout opportunities on REE once the February series is available.